A buyer finds a residential HVAC company earning $350,000 a year. The business has been stable for years. The seller says so, the financials show it, and the bank agrees, because the bank approves the SBA loan. The buyer closes the deal, makes the payments, and 6 months later loses one service manager. Summer weather runs mild. One service truck sits idle for weeks because the manager who ran it is gone. Revenue softens. Earnings drop from $350,000 to $275,000, and suddenly the buyer realizes that after the loan payment comes out every month, there is $145,000 left to run the entire company, not $350,000, not even $220,000, $145,000. The deal was not bad. The math just had less room than it looked like from the outside. There are 5 things experienced SBA borrowers understand before they sign that most first-time buyers figure out only after closing. This video covers all 5. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Most people who start researching SBA loans come in with a picture that is roughly correct, but missing the pieces that actually matter. They know the SBA exists. They know it involves a bank. They know there is a down payment. What they do not know is how those pieces fit together, and more importantly, what happens to their personal financial life after the loan closes. Start with the foundation, because the name creates confusion. The SBA, the Small Business Administration, is a federal agency. Its job is to help small businesses access capital they might not otherwise qualify for. It does that by guaranteeing a portion of loans made by banks and other approved lenders. On most business acquisitions, the SBA guarantees up to 75% of the loan amount. On smaller loans under $150,000, that guarantee can go up to 85%. The lender still holds the portion that is not guaranteed. That means the bank has real money at risk on every deal it approves. This is not a government handout, and it is not a risk-free transaction for the lender. When you hear someone say they got an SBA loan, what happened is a bank or an approved lending institution made them a loan, and the SBA agreed to back a significant portion of it if things go wrong. The government is not the lender, the bank is. That distinction matters for everything that follows. Number 1 is what you actually need to bring. Most first-time buyers hear 10% down and stop there. For many SBA change of ownership transactions, a 10% equity injection is a common starting requirement. On a $1.2 million deal, that is $120,000. But the cash you need at closing is almost never just the down payment. Closing costs, lender fees, and working capital reserves layer on top of that number. Seller financing can be structured to cover part of the equity injection in some deals, but how that counts varies by lender and by how the deal is put together. It is not automatic, and it is not universal. The point for anyone starting this process is simple. If you have exactly 10% saved, you may be undercapitalized before the deal even closes. Budget beyond the down payment before you start shopping for a business. Number 2 is the monthly reality. An SBA 7A loan for a business acquisition maxes out at a 10-year term for most deals. Longer terms are generally reserved for transactions that include significant real estate. 10 years sounds like a long time until you run the payment. On $1,080,000 financed at current rates over 10 years, annual debt service lands in the range of $125,000 to $140,000. Call it $130,000 as a working number. That is roughly $10,800 every month before you pay yourself $1. And that payment shows up every month. The business does not get a lighter payment in a slow quarter. Revenue can drop, a key employee can leave, a competitor can move into the territory, and the loan payment stays exactly where it was on closing day. Before you evaluate any business, calculate what the monthly debt service will actually be on the financed amount. That number is fixed. Everything else is variable. Number 3 is the cash flow cushion. Lenders look at whether a business generates enough annual earnings to cover its annual debt payments. That ratio is called the debt service coverage ratio. And most lenders want to see it somewhere around 1.25, meaning the business produces about 25% more cash flow than the annual debt service. But here is something that surprises a lot of first-time buyers. SBA lending works differently from a conventional commercial bank loan in one important way. A traditional commercial credit facility often includes DSCR as an ongoing covenant, a number the borrower has to maintain every year or risk triggering a default. Most SBA 7A loans do not work that way. Lenders use DSCR heavily in the approval process, and they will often accept projected coverage when the business fundamentals support it. But it is typically not a maintenance test you are measured against every year after closing. That flexibility is part of why the SBA program exists. Now back to the HVAC deal. In a normal year, $350,000 in earnings against $130,000 in debt service is solid. But in a soft year, when earnings drop to $275,000, the coverage ratio compresses fast. The business still covers the payment. What it stops doing is giving the owner much room to maneuver. That gap between covering the payment and having enough left to run the business safely is the cushion. And experienced buyers size it before they make an offer, not after. Number 4 is the personal guarantee. Everything so far lives inside the business. This one follows you home. Any owner holding 20% or more equity in the business is required to personally guarantee the SBA loan. That is not a lender preference. That is a program requirement. What it means in practice is that if the business cannot repay the loan, the lender can come after the borrower personally. Lenders will typically require all available business assets to be pledged as collateral first. When business collateral is not sufficient, they may ask the borrower to pledge significant personal assets as well, which can include a personal residence. Not every deal reaches that point, and not every lender goes there automatically. But every borrower needs to walk into closing with a clear understanding that this loan is not solely a business obligation. It is a personal one. Future videos will go deeper on the mechanics of the guarantee and what it actually looks like when a deal goes sideways. For now, the thing to hold on to is this. The SBA guarantee protects the lender's loss. It does not protect yours. Number 5 is the deal filter. This is where the first 4 items come together into something useful. Experienced buyers do not evaluate a business and then figure out the financing. They use the financing structure as a screening tool before they get deep into any deal. The question is not whether a bank will fund it. The question is what the business looks like after the bank gets paid, specifically in a year where things do not go as planned. Run the debt service math on the financed amount, then run a scenario where revenue comes in 15 to 20% below what the seller is showing. If the business still generates enough to cover the payment and leave meaningful operating cash, the deal may be worth pursuing. If the margin disappears under a modest revenue decline, the price needs to come down or the deal does not make sense at the current terms. That filter does not require a finance degree. It requires a calculator and a willingness to look at the uncomfortable scenario before you are locked into it. Here is what to take away from this video. The SBA does not lend money. It guarantees a portion of loans made by banks and approved lenders up to 75% on most deals. The guarantee protects the lender, not the borrower. The standard equity injection for a change of ownership transaction is often around 10%. But the cash you need at closing is almost always more than that. SBA 7A acquisition loans have a maximum 10-year term for most deals, and that payment is fixed from day one, regardless of how the business performs. Any owner with 20% or more equity in the business must personally guarantee the loan, and personal assets can be on the line if business collateral falls short. And the right question to ask about any deal is not whether the bank will approve it. It is how much cash flow is left after the bank gets paid, especially in a year where something goes wrong. If you are evaluating a business acquisition or getting serious about SBA financing, subscribe. Every video on this channel is built to give you the information before you need it, not after. Research the deal before you fund the deal.